let's break down this number further. Here with us in studio, we have Joe Brusuelas. He's RSM's chief economist. And we're also joined by Kathy Jones, Charles Schwab, chief fixed income strategist. Great to have both of you here. Joe, let me start with you. Just the magnitude of this miss, if you want to call it that, 12,000 jobs added to the economy last month. What's your first reaction?
All right, so this is a jobs report you want to take seriously, but not literally. The noise all over this report, it won't just be October, it's going to be November also. You can see the Boeing numbers inside the manufacturing complex, but also as I'm looking here, I'm seeing a pretty big downturn in professional business services, which is where you would expect individuals who work in retail, also in leisure and hospitality, which went down by 4,000. Those are going to be displaced workers because of Hurricane Helene. Now, the way we looked at this prior to the report was that we thought you'd get a movement in two parts. One would be October that would capture both the Boeing strike and Hurricane Helene. And then in November, we think that the Boeing strike will also be part of that, but you'll get Hurricane Milton. So essentially, guys, we're not going to get a clean look at the labor market until January of next year in the December report. Now, the 4.1% unemployment rate and the 4% increase in wages, that's a much better indication of the true underlying fundamental strength of the American labor market. Ignore that top line, look at that 4.1% and just get on with it.
Kathy, want to get your reaction to this report?
Yeah, I would agree with Joe that the non-farm payroll print was actually within the realm of what we would call the error range around what we were expecting. So if 100,000 was what was expected by the street, getting something even as low as minus 50 would have been within the range of possibility without it signaling a change in the labor market because of these temporary factors. So I'm encouraged by the household survey. I'm encouraged by the fact that average hourly earnings are hanging in there right around 4%. I would agree, kind of push this one to the side. Look at November and see what we can figure out from November, which may not be much, and then just keep moving.
Joe, do you think the markets are going to continue just taking this number in stride, just given that noisiness?
Yeah, this is all noise. It's just distortions. Market will move on, so will the Fed. We'll get that 25 basis point cut November 7th. But hey, guys, the U.S. economy is in such a strong position now. The Fed may choose to pause in December because they need to take a moment and ascertain if the growth path has meaningfully shifted up from the long-term trend growth rate of 1.8% that's embedded in their forecast to something closer to between 2.5 and 3. Now, if that's the case, we'll see that, at least migration towards that, in their December SEP. That's a much bigger deal than any of this.
Kathy, are you anticipating that we'll still get the cut at the November meeting here? As we're taking a look at the CME FedWatch tool, it looks like there's still a 91% chance, or probability rather, for a cut that many out there are trying to perhaps bake into their own kind of estimates around how the markets should react to that.
I do expect the cut in November. There's a case for a pause, simply because we had those upward revisions to the September numbers. And as Joe pointed out, the economy has been growing at roughly 3% pace, which is well above what the Fed sort of thought was the run rate here. But I think we would have gotten some signal from the Fed if they were inclined to pause on the November meeting. A December pause, much more likely. And after that, the market's already anticipating a much shallower path of rate cuts going forward by the Fed. And I think that will be reflected in the next dot plot and the next SEP as the Fed comes around to this view that perhaps, the economy, due to productivity growth, due to underlying health in the labor market, the economy is really growing closer to 3%. And that would mean fewer rate cuts going forward than they had anticipated just a few months ago.